All right, folks, my next guest is now talking about how rapidly rates are rising, how things are rapidly changing, and, well, people are going to have to change with it. Part of that change, though, involves painful default spikes. I'm going to bring in now the Kobeissi letter editor-in-chief, Adam Kobeissi. And, Adam, say it ain't so, my man, but the era of free money is officially over. It was fun, though, while it lasted, but now let's talk about the hangover a little bit. What are you expecting?
Yeah, so, I mean, right now you're seeing rates keep moving higher. The Fed's set to pause for longer, and that's really been our call. I know I was on a couple of weeks ago with you calling for the 10-year note yield to 4.5%. We're still kind of seeing the same pressures. We're now at 4.3%, so we're only 20 basis points off now, which is pushing TLT lower. And ultimately, I think the era of free money being over is kind of a overarching theme of everything we're seeing right now. From rates rising to markets more in volatility, borrowing costs rising, U.S. deficit spending rising. It's kind of all playing into each other, which is definitely an interesting trend.
Well, I tell you what's even a little bit more, I would use a stronger word than interesting for Main Street, right? So mortgages or housing is as unaffordable as it's ever been. There are no cheap, affordable cars out there. Rent prices are through the roof. So it might be cheaper to rent than to buy, but either way, you're losing out on the American dream. And it feels like it's going to get a lot worse, Adam, before it gets better. Is that your position?
Yeah, I mean, I think affordability, I mean, everything you're alluding to is just about affordability. I think affordability is really going to keep getting worse, particularly in housing, as you mentioned. Buying and renting is historically expensive. I mean, the median asking rent now is approaching $2,000 a month for the first time ever. The median monthly house payment is now at around $2,800 a month. And it's tough to see a situation where that gets better because with rates rising, you have 90% of borrowers are locked into sub 5% interest rates on their mortgages. Roughly 30% are below 3%. Right. And then you have this situation now, which we're calling for, where the Fed's, instead of raising further, it's just going to be a very long pause. We don't expect the Fed to start cutting rates until at least May to June of next year at this point. And in an environment like we are now, you kind of need lower rates to cause housing prices and rents to fall. It's kind of an ironic situation. But as long as rates stay high, in which we believe they will be for the next few months at the minimum, affordability for Main Street doesn't seem to be improving.
So let's talk about your positioning here. You're bullish on the S&P. You're bullish on crude oil. We've talked a lot this show about that. You're still bullish on gold, and you're bullish on yields. Of course, you're bearish on bonds. I'm curious why you're bearish on natural gas.
So natural gas, this has been one of the best short trades of all time. We've been trading this short basically, we've been playing it to this downside for the last few months. Every single time natural gas prices spike, the fundamental situation is just not strong enough for a sustained rally, and that's kind of been our thesis. Technicals are showing lower highs continue to form, and we had this overarching inventory glut that started in the winter. So it was supposed to be a historically cold winter, then it was mild. Then it was supposed to be a very hot summer. It ended up being mild. So you kind of had this big inventory glut building.
Right.
And every time that natural gas prices rally, we just see it sell off. So we've been selling into strength there.
All right.
Whereas on the other end of the spectrum, crude oil, as you mentioned, we've been bullish, calling for prices towards 90 for a couple of months now. We're at 87, 88 after that news yesterday from Saudi Arabia. And we just think OPEC is really committed to higher for longer oil prices, which is something that's honestly surprising many people.
Yeah, ironically, when I saw that people were surprised they extended the production cuts, I was a little surprised that anybody was surprised. By the way, I'll let the audience know you do like Meta. You like Meta calls here. We got to leave it there. Hey, Adam, thank you very much, my friend. Appreciate it.